The EV game is getting tougher and tougher, and guess what? Many EV makers are feeling the heat. These companies are starting to lose their ground, and in no time, they may be out of the EV game completely.
And so at a $32,000 post-rebate for the Model 3, that's already less than the average cab, internal combustion engine car in the United States today. But if Elon can get a $25,000 Tesla on the road in 2 or 3 years, that's the holy grail. That'll single-handedly accelerate EV production probably 2 years.
Meantime, we've got an earnings alert on Ford. Shares are lower as the car company missed on the top and the bottom lines and withdrew guidance. Phil LeBeau joins us live from Dallas with the latest. Phil.
Hey, Melissa, we are about 40 minutes into this analyst call. No major headlines so far. Jim Farley talking about their continued push to prioritize hybrid vehicles as demand for electric vehicles cools off here in the United States. Couple of thoughts. They missed on the top and the bottom line in the third quarter. This is the problem we've talked about before. One issue here is the warranty cost issue continues to be just it nips at the heels of Ford, and that's one of the reasons why they fell short, along with the UAW strike.
Tesla is the undisputed American EV champion, a position that will likely maintain for some time. Despite the challenging market conditions, the automaker has been growing its EV fleet and scaling up its production. But other EV makers do not have it this good. In fact, many of these other companies are starting to back out of the race entirely. So today we're going to go through some of the auto companies that are cutting their EV sales forecast and why they're doing it. In the long run, this could be a big deal for Tesla and its stock.
When we look at the way Tesla trades, you know, there's always, is it an auto company? Is it a tech company? What do you think about the current valuation of a stock like Tesla? And where do you think it is fairly valued?
Look, Tesla's going to do roughly $100 billion in revenue. People always used to say, Tesla's a cool company and the cars are nice, but they're not selling many vehicles. Well, now they're selling a lot of vehicles at $100 billion revenue, growing 40% a year. I think having a 6x revenue multiple is probably fair, and I think there's a lot of upside for growth. What people forget is they're still profitable, and they still have an edge in both manufacturing, over-the-air software, and other things that other companies just can't duplicate. The big picture here is, can the Chinese, with their lower cost battery and lower cost manufacturing, compete with Tesla's edge, which is the most advanced production facility in the world and the ability to sell over-the-air software faster than anyone.
EVs are becoming more popular amongst consumers thanks to their environmental benefits, technological innovations, and government incentives. However, not all auto companies are enjoying the same level of success in the EV market. Some of them, like Toyota, Ford, and GM, have recently announced they're cutting their EV sales forecast for 2023 and beyond, citing various challenges and uncertainties. We believe this could be a big deal for Tesla, which is already the leader in the EV industry, as it may gain a competitive edge over its rivals. So why are these auto companies cutting their EV sales forecast? Let's dive into the details. Hey guys, welcome back to Tesla Tomorrow. One of the main reasons why some auto companies are lowering their EV sales expectations is the global semiconductor shortage, which has disrupted the production and supply of many electric components that are essential for EVs. According to Fitch Solutions, the chip shortage had severely limited EV sales growth in 2022 and affected a lot of companies. Toyota, for example, has drastically cut its EV sales forecast by nearly 40%, from 202,000 to 123,000, reflecting the decline of the Chinese market where the chip shortage has intensified the price competition. Although Toyota expects record growth this fiscal year, it is cutting its EV sales forecast and plans to lean into hybrids to avoid the price competition in the EV market. Even though the car company still expects to sell 9.6 million vehicles this fiscal year, it still expects a lower share of EV sales. Before we carry on though guys, if you like this type of content, hit that like button, subscribe and turn on post notifications to keep up to date on everything going on with Tesla. Another reason why some auto companies are scaling back on their EV plans is the shipping delays caused by the pandemic, which have increased the cost and risk associated with shipping vehicles around to different parts of the world. Ford, for instance, has delayed around $12 billion worth in EV manufacturing investments and postponed its 600,000 EV production goal for another year. GM has also pushed back the production of some of its EV models to protect its pricing. The truth is, Other EV manufacturers aside from Tesla are feeling the impact of lowering pricing. Ford recently withdrew its full-year results forecast and warned of continued pressure on electric vehicles. The auto company lost an estimated $36,000 on each of the 36,000 electronic vehicles that it delivered to dealers in the third quarter, even more than the estimated $32,350 in losses per EV in the second quarter. During Ford's second quarter earnings briefing in July, the company's CEO Jim Farley said Ford would slow the ramp-up of money-losing EVs, shifting investment to its commercial vehicle unit and citing plans to quadruple sales of gas-electric hybrids over the next 5 years. This goes a long way to prove that Tesla is the only car company that's enjoying the EV ride so far. A third reason why some auto companies are revisiting their EV sales forecast is the limited battery production capacity, which contains the availability and affordability of EVs within it, and it's constraining it pretty hard. Battery makers like Panasonic and LG Energy Solution have warned of an EV market slowdown due to the lack of battery supply and the rising costs of raw materials. For this reason, some auto companies like Honda have abandoned their plans to make affordable EVs with other partners like GM due to the battery challenges. So why do we think all of this could be a big deal for Tesla? Well, the fact that some auto companies are cutting their EV sales forecasts could be a big deal for Tesla and give it the opportunity it needs to expand its market share and strengthen its leadership position in the EV industry. Tesla has been able to overcome some of the challenges that have affected its competitors like the chip shortage, shipping delays, and the battery constraints by adopting innovative solutions and strategies. For instance, the automaker has been able to source alternative chips and rewrite its software to adapt to the changing supply situation, minimizing the impact of the chip shortage on its production and shares. Tesla's also been able to leverage the global network of factories and suppliers as well as its direct sales model, all to reduce the shipping costs and risks, and deliver its vehicles faster and more efficiently to its consumers. The EV maker has secured its battery supply and reduced its battery costs by developing its own battery technology and forming strategic partnerships with battery makers like CATL and Panasonic. As a result, Tesla's been able to maintain its strong performance and growth momentum in the EV market despite the challenges and uncertainties. The company sold more than 557,000 battery electric vehicles in the first half of 2023, breaking its own records and accounting for more than half of the total BEV sales in the United States. Tesla also increased its market share in key regions like China and Europe, where it faces fierce competition from local and global rivals. It has raised its production and delivery targets for 2023, aiming to reach 1.8 million vehicles, up from 1.3 million in the previous year. Therefore, by cutting their EV sales forecasts, these other EV makers have helped to enhance Tesla's reputation and brand value in the EV market. And that move will wind the gap between Tesla and its competition and help Tesla capitalize on the growing demand for EVs from consumers, who are becoming more aware of the interesting advantages of electric cars. As these other companies continue to lower their EV sales forecasts and consequently manufacture less EVs, Tesla could leverage the competition that it's got and then turn that edge on in terms of production quality, design performance, and customer satisfaction, and use it to cut into the market and eventually gain more shares. But what other ways do you think Tesla can leverage that opportunity? Let us know down below, and don't forget to tell us what your valuation of Tesla is. And if you want to know more about what Tesla's been up to over the last few days, go ahead and click on this next video on your screen. See you there.